Hi everyone, today we're going to be talking about Hollywood Bowl stock, and it's a stock that I own, and it's a stock that, because I talk about it quite a bit, I have quite a lot of comments talking about Hollywood Bowl, and I thought it would be best to make a video just going through the company, why I bought into the company. And I was actually thinking like something very similar for the Greggs, because I get quite a lot of questions about Greggs as well. So I don't know if I should, but I'm kind of thinking about making a separate video about Greggs as well, and if Greggs stocks is a buy. But today I'm going to be covering Hollywood Bowl, so I know a few of you guys had some questions about it. So hit that like button, guys, and we'll get stuck into Hollywood Bowl. So Hollywood Bowl is a company that I started buying probably about a month ago, maybe even a month and a half ago now. And there's a few reasons why I bought this company. It's a company that I have used before previously. They have a venue actually in where I live, in the city that I live. And when I buy into a company, I always like buying companies that I use, because I can get a good feel of how the company does, how busy it is there a lot of demand for it. I think using the actual product you're investing in gives you a massive advantage, especially like understanding it wise. So I was originally drawn to that because I know the product, or in this case as a service. And Hollywood Bowl is one of the biggest temping bowling companies that are in the UK right now. There is some other benefits as well, this company, just not the bowling side, but we'll get onto that. So we'll get stuck into some of the fundamentals with Hollywood Bowl. I'll also talk about what's going on with the company, and also how the CV is going to be affecting this company. So Hollywood Bowl, ticker symbol BOL, is about £1.38 as I recording this video. It's down 50%, so the share price is absolutely halved. I always like looking at stocks that are on discounts, because it's something in the sale. If you really like a t-shirt and it was £40 and you saw it again and it's £20, you wouldn't say really no to it. So when you see discounts like this, I like buying them opportunities that are out there. You're getting something fantastic for half the price or 20% off, and that's how I like to look at it. Now, this stock is down 50%. Obviously, it's fallen off a cliff right now. It's a really cheap prices. Now, the reason why is obviously because of the coronavirus, and we'll talk about that towards the conclusion side. But obviously, this is one of the companies that you look at, and there's a lot of risk out there because it is a kind of leisure company, and these companies have a lot more risk because they're more influenced with the CV and how they operate. At the same time, you look at a lot of these companies, and even though there's a lot of risk, there's potential for 100-200% upside, and that's why people are willing to take that risk. If you're a little bit more adventurous and you will take that risk on and you want the bigger gains, these are the companies you look at. If you're kind of more of a safer investor, then obviously you're going to sway to other companies that aren't obviously affected, a little bit more less volatile, for example. So it kind of goes, this is a company that goes down to you as an investor. How risk tolerant are you? Can you stomach a lot of the downs? Because a company like this can go even lower than these prices. At the same time, a company like this will offer you performance that can outperform the market, 100-200% return. So it goes down to your risk tolerance, and if you can take that risk. And that's taking these risks is what I like to do. I'm quite a young investor. I don't mind taking all these risks. I don't really need the money right now. And sure, at some point I might get one of these wrong and it might go down. But how previously, like, my investing style has gone, I've been successful taking a lot of these risks. So I don't mind taking a dive into some of these companies like Hollywood Bowl. So the company itself has a P ratio of 9, which is pretty low. When we look at the future forecast for the revenue and profit, it is massively going to go up. When we look at the past performance as well, this company has done really well in the past performance of its EPS, of its revenue. So its bull case for it going up in the few years is fantastic, and the past performance is absolutely fantastic. A company that's churned out profit increase in the past, which is great. Simple Wall Street have it undervalued by about 40%. Yahoo Finance have it with a potential upside of 100%. So analysts are generally pretty bullish about this stock still. Balance sheet it offers some good cash, 25 million, debt 25 million. I know these have changed slightly because I think it has raised a little bit of cash, and I know it's burning through a few cash. So these figures are probably going slightly out of date to what's actually going on right now. But previously, before the coronavirus, 25 million in cash, 25 million debt, that was quite a healthy balance sheet. Assets to liabilities were pretty equal as well, so it's in a pretty decent position financially. Pre-crash as well, it offered a decent dividend of about 4 to 5% dividend yield, Obviously, with not operating, it makes sense to cut the dividend and save cash. So from their point of view, it was a good decision to cut that dividend and stop it for a little bit. Obviously, when it opens up, it should go back to paying a dividend with a low payout rate. The payout rate was like under 50%. And as well, when we look into the company fundamentals, when we look at the ownership side of it, there's a lot of insiders actually starting to buy this company right now, one of them being the CEO, which is a great sign, because if these companies are looking at the stock and going, this stock, our company is really low down, let's buy it, we know what's going on, we know that we're going to be fine, we're going to carry on making profit. These guys putting their own money into the company who know much more details about what we do is a really great sign. If this company was having to look at closing venues down, selling assets off, the investors probably wouldn't be buying this company because they know that the share price would go down after that news. So for me, seeing a lot of insiders, even the CEO buying shares, absolutely fantastic with Hollywood Bowl. Now the company itself, when we dive into that investors relation report, we look at how many venues they have. They have 60 venues. All of these venues are profitable, and this goes down to how good that management team is. The Hollywood Bowl tend to get into locations where it's kind of nearby a lot of things, so cinema, restaurants, so they can tie it in with people that go to a movie but then they want to go for a drink in like the bar that they have. They also have the arcade and also the bowling, so they might go for a meal and then go bowling. There's a lot of combinations that can happen, but the location selection that Hollywood Bowl do is a really good location that brings people in that are also wanting to go to different places. So the selection process is fantastic, and that's led to all profitable venues, which is absolutely great. Now this company is diversifying. Originally, if this was just a bowling company, I would be slightly worried with its revenue only coming from bowling. But now it only makes up about 50% of its revenue. Its other 50% come from its arcade and its bar. So that's absolutely fantastic that it has them free revenue income streams. So we'll get onto that about the coronavirus a little bit later, but the diverse revenue is a really good thing. Growth wise, they are going to grow this by, they have been refurbishing a lot of their centres. I've noticed the one near me actually got done up about 2 years ago, I think. So it is going around and refurbishing them, which the interiors look absolutely fantastic. They are looking at opening up more sites, so there's 10 centres in the pipeline to 2023, which is an absolute amazing increase. That's obviously a big jump that will push EPS and revenue up. So that's going to be good from their point of view, having more centres. That means more profit, more revenue. And it's also looking at opening up a mini golf into its venue, so that could be a fourth income stream. And I believe that there's other things they could look at getting in the venues which would do really well. So they are looking to diversify that revenue and also having more venues. So for the EPS and revenue, I can only see this one going up. And if the EPS and revenue goes up, I can only see the company making more profit, a bigger dividend, more people buying into the stock, and I see the share price going up. So from the company's point of view, it's a really well managed company with a lot of good things going on inside. So I think this company is fantastic with its diverse revenue, the centres, the more centres opening up, and the management did a really good job on that balance sheet, and that's why I bought into this company compared to a lot of other leisure companies. That's why I didn't buy Cineworld, because of the debt level. When I look at Hollywood Bowl, they will be affected as much as Cineworld, but with the balance sheet that they had, I really like that from the company. Now, obviously, the big thing why the stock is down is the coronavirus, and this is a risky stock. This is probably one of, I would say, one of the most difficult industries to be buying into, because you are going to have to stomach a lot of risk. There's potential for your stocks to go down, but with this one, I think there's a 100% to 200% upside on this company in a 2 to 5 years when you look long term. Obviously, the CV is going to affect them short term and how they're going to manage that. From the first income stream, which is the bars, I think that should be okay, because you'll be able to social distance in the bar, so you just move your tables a bit further away. I don't know about you guys, but the ones I've been into, the tables are pretty far away already, so that won't reduce capacity at all, so I think that area is fine. You've got the arcade. Now I think this is a little bit of a difficult one. I'm not 100% sure how they'll manage that one. I don't know if they'll have to have hand sanitizer before you go into the arcade and use the arcade to come out. That is a slightly tricky one. Now obviously 50% of the revenue comes from the bowling side of it. I don't think the bowling one will be that difficult to manage, because if you think you go to a bowling lane with your family, with your friends, your group of circle that you're with, so that's totally fine. The lanes are pretty far away from each other, so I reckon they're probably 2 meters away. I mean, you could put a board up between where the balls are, and you could carry on using the same balls then, and then after you use it, there's a cleaner that comes around and like disinfects the seat and then wipes the balls. I think that is totally manageable, and then you can social distance from there. So I think the bowling side of it is quite an easy one to get up and going because of naturally who you go with and how the lanes are actually set up. I think the only tricky one with this one is the arcade side of it. I am not sure how they'll manage that, but I think from the bars and the bowling kind of view, I think they're really able to open up when they are allowed to. So I think that these guys could get back to operating within maybe even July time, potentially June, but I'd say July. So I think the company can make it through another 2 months with the cash it has and the cash that it would have raised over the last couple of months. So I think from the company's point of view, it's safe. It's a company that could probably operate quite well. Obviously, I think it might lose the arcade side, but the bar and the bowling should be totally fine, which is 75% of the revenue, and that should probably operate at full capacity as well. So I think that's a pretty good position for Hollywood to be in. And eventually that arcade will come back. Long term, the venues come up and they have more revenue in EPS when the social distancing calms down a little bit. So I think 2 to 5 years, this obviously has a lot of risk, but for me, I see myself making 100 to 200% on this company easy. I would not settle for less than 100% on this company. And as well as that, 2 to 5 years, I hope that dividend comes back and I'll pick up that dividend as well. So I thought I'd cover Hollywood Bowl for you guys because I think some of you guys want me to go into a little bit more detail about that and give it its own video. Like I said, if there's a demand for Greg's, I could do Greg's as well. But anyway, I'll leave that one into the comment section and see what you guys say. I'll sooner or later will be doing my free stocks to buy in June, which is kind of crazy. So I'll be doing that probably next week as well. So I'm going to be pretty busy making them videos next week, but the week after I shouldn't be too bad to get into some more stocks and take a deep dive on them. So thank you for watching the video. As always, if you can like it, that'd be absolutely amazing. Subscribe if you haven't, and I'll see you in the next one.